Well, thanks for that introduction, and thank you for attending today. So my brief over the next kind of 20 minutes is just to talk generally around kind of what we're seeing in the economy and what the recovery will look like. And probably like you know, I do realise that there's probably a bit of coronavirus fatigue, so I'm not going to talk for 20 minutes on coronavirus. I'm sure it's in every paper that you read, every kind of news at night. But I think what we do is we do look at the impact at a very different point of view. So we look at it from a financial impact point of view, and there's just a couple of kind of lessons that I think the average kind of investor is missing with this. So in the last month, you may know, the share market has kind of bottomed out and really started to rally. And I think a lot of investors, when they look at the economy, are really quite perplexed with that. So I really want to educate you on kind of why the share market is able to rally as well, and some of the key things you should take away. So firstly, I mean, I've only put 3 slides on the economic data because I think 3's, probably heaps to tell you the story, but essentially, if we look at any type of economic measure, the economy really effectively is stopped at the moment. So probably the biggest measure ever to look at is GDP. GDP measures kind of production of an economy. And you'll all remember that 10 years ago, we had the global financial crisis. Just to give you some context of how bad the economy is at a short term at the moment, through the global financial crisis, GDP contracted by 0.1%. Today, the IMF and the World Bank kind of expect GDP to contract by something like 3% this year. So very large contractions. And without labouring in the obvious, we haven't seen a contraction like that any time in the last kind of 100 years. So we are looking at very kind of unique economic situation at the moment. And it is also a global event. So it's not Australia-based, it's not the US, it's all developed nations and also all emerging markets as well. So we're seeing that impact kind of all economies very steeply. Again, I mean, many of you'll know, certainly if you're in advertising, consumer discretionary spending in Western nations is about 70% of GDP. So as a result, it's always, some of the indicators that we always look at is around consumer spending, and kind of advertising is, it leads into that. You've never ever seen 100% decline in consumer spending like we have in the space of kind of 2 weeks. And that's a global phenomenon. This data point here is restaurant reservations. So as you can kind of see, it's gone from, a horrific kind of reading would be something like, -5, to go to -100 is really unprecedented. Next slide. And finally, jobless claims, unemployment. We're seeing that massively spike, not only in the US, but also Australia. And just to give you some context to this, the unemployment slide that's just kind of bouncing around the bottom, that's usually between 250,000 and at the peak of the GFC was 700,000. So to go to 7 million is unemployment claims like we've just never really witnessed before. So look, I could probably show you, another 1,000 slides on the economic growth, but they're going to tell you the same story. Effectively, the economy really is stopped. But as I said, when we think about the economy and the opportunities in markets, the first thing to understand is the economy. The second thing is, well, what is the effect on kind of markets? And for a number of reasons, the share market has kind of bottomed around 6 weeks ago. And the first reason of that is that this market, the first thing that's happened is you've seen policy response. So that's fiscal spending by governments. And potentially, I think Tony's going to talk about some of the measures we've got in Australia, or for your own businesses. There's some fiscal measures, but you've also seen central banks weigh into the markets, and effectively the central banks kind of print money and buy assets. And so they really support financial markets, bond markets and equity markets. And that's actually been the biggest, had the biggest impact on the financial markets that we follow. Next slide. Yeah, and the GDP measures as well. So again, most governments around the world have just said, look, whatever it takes. So the policy response is that ultimately this is not a structural problem. It's really a decision to shut down the economy to kind of save lives and for the health of people. So the policy response is effectively to build a bridge between where the economy was before, once it's shut down, and then when it kind of reopens again. And again, we haven't seen fiscal spending in the magnitude that we're seeing globally outside of kind of world wars and situations like that. So we do think the policy response and the government are going to backstop the economy and take probably the worst kind of financial aspects out of it. Next slide. Yeah, and this is just another slide as well, just to really illustrate that it's monetary policy and fiscal policy. I mean, one of the other things I'll talk about and the opportunities, it's an opportunity for some and it's, you know, a bit of a pain point for others, is that there's very little opportunity to earn, you know, riskless rates of return on cash anywhere in the world. So central banks everywhere across the world have really dropped their rates down to kind of zero. And I guess as investors, you would see that mainly through things like term deposits and cash rates. So the reality is, if you've got your retirement savings or your personal money invested in cash, you're probably looking at negative real rates of return. And when I say real, I mean after inflation for the foreseeable future.